Hey guys, what's going on? My name is James Mason. In this video, I'm going to explain to you what a EMA line is and what a SMA line is. Alright, so the first thing I'm going to do is just to take away some noise out of my charts. Just get rid of the rest of my indicators except for my EMA trend lines. Alright, so what is a EMA and SMA and how to use them? So, what does EMA and SMA mean? EMA stands for Exponential Moving Average. SMA stands for Simple Moving Average. Though relatively the same, the EMA has more weight applied to it, making it a little more accurate when it shows an up or downtrend. The SMA is a trend line based off of the true average that, that line's time period is for. So it actually takes longer to show its up or downtrend. These are two of the most popular moving averages. Also, these lines are used to form a trend, following an indicator, as you can see right here. They show the price action, based off of the past price for that time frame. So the next thing is, what is a bar? Well, a bar is that period of time represented in your charts. Example, 1 minute chart. This is my 1 minute chart. Each candlestick is 1 bar measured in 1 minute. So this is 1 bar, and the time frame it is measured in is 1 minute, since this is a 1 minute chart. If you go over here to the 5 minute chart, it's the same. This right here is 1 bar, but it is actually measured in 5 minutes. So when you hear of a 9-bar EMA for a 1 minute chart, or when I talk about my blue EMA line, that line is a weighted average for that time period over the course of 9 bars, which in this case 9 minutes. So if you look over here, this blue EMA line, it's the same thing. It is measured over 9 bars, which represents 9 time periods, and each of those time periods represent 5 minutes each. So these trend lines move up or down based off of the average over the last 9 bars for that time frame. Now, other people use different periods of time for their EMAs or SMAs. Me personally, I like having it measured in 9. It works for me in my trades. So let me open up my studies so I can show you my settings. Okay, so when it comes to the moving average, the longer the average, the more it lags in movement. That's why I choose 9 for my first EMA which I don't know why it's dropping down to there. Okay, so this is why I use 9 for my first EMA, which is the blue line. Now, contrary to that, if you choose a lower number, it will ride the price action in the candlesticks way too close. Basically, your trend line would end up looking like a heart monitor instead of giving you that smooth visual, from the movement of the trend. So this is what I mean right here, the smooth visual. And let's just say if you had it something crazy, let's just say this was set to like 3, which would be worthless. Like it would not work out. It would just be, it basically look like these candlesticks. So it would end up being irrelevant. So why do I use 4 different EMA lines? Each line represents a different time period for which it is weighed. My blue line right here, it is weighed in 9 bars. So, going back to what I said in the beginning of this video, this is my 1 minute chart. So it is weighed over the past 9 minutes with that average for that price. The same holds true for the rest of my EMAs. So for my gold bar, that is my 20 line, or my gold line, that is my 20 bar. So that is measured over 20 minutes. My red line, that is 50. The green line, that is 100. The purple line, that is 200. The most popular time periods that traders usually use is the 9, the 50, and the 20 EMA lines. And the reasoning for that is the 9, this will be your short-term average movement. The 50 is your mid-range, and your 200, that's your long range. So when you are trading, as your candlesticks move between these EMA lines, you will notice they will act like supports and resistances. So let me scroll through here and try to find something a little bit better. So for instance, with ticker Google, if you look at this 200 bar EMA line, you can see in this area right here that as it approaches, it just keeps getting rejected, and it can't make it past that. And then it eventually goes under. Now, with this ticker, if you look at the 200 EMA line, you can see that it acts as a support. So right here, it comes down and it stops and it goes back up. And as we go over, you see it start happening there and there. And right here, it breaks through just a little bit, but then it consolidates on that line, and then it goes back up into an upward trend. So obviously, this is what an upward trend looks like. And you know, this is just a 1 minute chart. Now, it's obvious what a downward trend looks like. And it's that right there. Alright, so let me go back up here. Alright, so what is a double crossover? It's when two moving averages cross each other to signal either a bullish crossover or a bearish crossover. A bullish crossover happens when a shorter time period, EMA, crosses over the longer time period, EMA, which would be this right here. So as you look at this, let me see if I can find something a little bit more clear. Okay, so as you look at this EMA right here, this blue EMA line, it is the shortest, it's the shortest time period EMA that I have, which is weighted at 9 bars. This gold, that's a 20 EMA line. So the shorter bar, when it crosses over a longer bar or line, that is what is called a golden cross. Now, a bearish crossover happens when a longer time period EMA crosses over a shorter time period EMA. Alright, so this makes it very, very easy to see now. So again, I'll repeat that. A bearish crossover happens when a longer timed period EMA crosses over the shorter time period EMA. So this is the longer time period, and as it crosses over right here, that is what is called the dead cross, and that signals a strong, downward trend. So that's why it's called a bearish crossover. As you can see right here, has this, when it crosses over, it has this massive candlestick, and then it goes down right here. So when the candlesticks move above the EMAs, that is called a bullish price crossover, and that signals an upward trend. So right here, you see the candlesticks are below the EMA, and when they go above it, that signals an upward trend, and that is called a bullish price crossover. And it's the same for when the candlesticks go below the EMA line. When the candlesticks go below the EMA line, that signals a downward trend, and that is called a bearish price crossover. So To summarize this, moving averages show a trend with a slight lag. The trend that it shows will help you make your best trades once you know how to use them, which, that takes time and experience. Moving averages should not be used on their own. You have to take other indicators into consideration as well. So that concludes this video, and I hope this video helps some of you out. If you found this video valuable, please subscribe to my channel. Please give it a thumbs up and share it for me. I'd greatly appreciate that.